Throughout history, collapses did not destroy everyone. They destroyed most people and spared a few. Not because those people were smarter, not because they predicted the collapse, but because they were positioned differently. In Weimar Germany, a lifetime of savings could no longer buy a loaf of bread. In Argentina, bank accounts were frozen overnight. In every collapse, paper wealth disappeared. And yet, some people did not lose everything. They followed the same principles, regardless of the country, the century, or the cause. This is not about getting rich. It is about not losing everything. Because in every collapse, most people lose everything. Not because they are foolish, but because they follow strategies that work in normal times and fail in crises. Throughout history, regardless of the cause, the country, or the century, some people survived collapses because they followed the same principles. Some even lived in prosperity. History shows us that a stable currency can turn into worthless paper within 5 years. Weimar, Germany, November 1923. One loaf of bread cost 200 billion marks. If money had been kept in marks, the savings of a lifetime would have bought nothing. A bank account that could buy a house in 1918 was reduced to bread by 1923. 5 years. That is how long it took for a stable currency to turn into worthless paper. In Argentina, in 2001, people could not access their deposits when the peso was frozen and banks were closed. The government seized dollar accounts and converted them into pesos at a fraudulent exchange rate. Overnight, they lost 66% of their savings. But some people survived. In every collapse, regardless of place or century, they followed the same principles. America, 2025. While the currency has lost most of its purchasing power since 1913, national debt has reached historic levels, and trillions of dollars have been created within a short period. The same model has repeated before every major monetary collapse in history, whether it unfolded over 5 years or 15. Here are the 5 principles that allowed people to survive collapses throughout history, why they worked, and how they were applied. This is not about getting rich. It is about not losing everything. Because in every collapse, most people lose everything. Not because they are foolish, but because they follow strategies that work in normal times and lead to disaster in crises. First, it is necessary to explain why principles are more important than tactics. A tactic is a specific recommendation. Buy gold. Sell stocks. These may work or may not. They depend on timing, the specific collapse, and thousands of variables. A principle, on the other hand, is a fundamental truth that works regardless of the collapse. Most financial advice is tactical. It assumes that banks will remain solvent, governments will honor contracts, and property rights will be enforced. In a collapse, these assumptions break down. When systems fail, principles are all that remain. Principle 1. Tangible assets survive. The first principle is that tangible assets survive. Paper money burns. When currencies collapse, governments default, and financial systems fail, physical assets preserve their value because they are real. Paper assets are only enforceable claims, and in a collapse, those claims can no longer be enforced. In Weimar Germany, paper wealth evaporated. But people who owned tangible assets, land, buildings, factories, farms, survived. A farm before the collapse was the same farm after the collapse. It produced the same food. Its real value did not change, even as its price exploded in nominal terms. The same pattern appeared in Zimbabwe in the 2000s and in Argentina in 2001 and 2002. Savings held in currency were destroyed. Land, livestock, and equipment continued to produce value. Tangible assets survived. Paper money disappeared. Principle 2. Own productive assets, not speculative ones. Productive assets generate income, food, or utility regardless of market prices. Speculative assets are only valuable if there is a buyer. During the Great Depression, the stock market collapsed, but farms, rental properties, and essential businesses continued to function. A farm produced food whether markets were high or low. Speculative assets required buyers. In a collapse, buyers disappear. In Venezuela in the 2000s, the stock market rose dramatically in nominal terms while the currency collapsed. Those who survived owned productive assets, bakeries, farms, transportation businesses. They produced what people needed. Speculation did not. Principle 3. Debt destroys. In stable times, debt is leverage. In collapses, all debt becomes destructive. Income falls or disappears, but debt remains unchanged. During the Great Depression, farmers who had borrowed heavily lost their land through foreclosure. Farmers who owned their land outright struggled, but survived. The difference was not effort or intelligence. It was debt. The same pattern appeared in Argentina and Greece. Families with mortgages lost homes when incomes collapsed. Those without debt kept what they owned. In a collapse, debt converts temporary hardship into permanent loss. Principle 4. Skills are portable wealth. Land can be seized. Money can be inflated away. Businesses can be nationalized. Skills remain. Throughout history, those with skills, doctors, engineers, craftsmen, repairers, were able to trade labor for food, rebuild in new places, and survive systemic destruction. Skills exist in the mind. They cannot be confiscated. Principle 5. Local trust networks outlast institutions. When systems collapse, institutions fail. Banks close. Governments lose authority. Local networks remain. In the Soviet collapse and in Argentina in 2001, people survived through family, neighbors, and local communities. They traded, shared resources, and provided protection. Isolated individuals with money in the bank struggled. These are the 5 principles. Tangible assets survive. Productive assets create value. Debt destroys. Skills are portable wealth. Local networks outlast institutions. Notice what is not on this list. Which stocks to buy. Which currency to hold. Which asset will rise fastest. These are tactics. Principles work regardless. In our previous breakdown of collapsing systems, the pattern becomes clear. Timing is not required. Certainty is not required. Positioning according to principles is sufficient. Collapses do not announce themselves. When they become obvious, it is already too late. Principles provide protection without prediction. They have worked for thousands of years across empires, systems, and currencies. The tactics change. The principles remain. Positioning according to these principles increases the chances of surviving what comes next. If this helped you understand the system more clearly, like the video and subscribe. More practical money insights are coming.